great to see everyone here. We're excited for what we'll learn today. We have an awesome speaker with us. We have a lot of information ready for you, which we know will impact your investment journey. My name is Naila. I work with AIB-AXYS Africa. And today our webinar is on focused investing, how to build wealth with core stocks. Our speaker, Ronnie, is our senior research analyst with AIB-AXYS Africa. He has a lot of experience in the markets and a lot of knowledge and wisdom on how to steer your way successfully through the market. So we are all looking forward to hearing from you, Ronnie. And so I'd encourage you to take out any notebook or pen that you have, because you will learn a lot today. And we would also like to hear your questions at the end. We'll have a Q&A session at the end. So feel free to write your questions as we go along in the chat, and then we'll address them in the last 15 minutes of the webinar. A quick intro into AIB-AXYS. Maybe you've not heard about us, before I hand over to Steve from CDSE, our partner today, to introduce himself. So AIB-AXYS Africa, we are a stockbroker in Kenya. We are licensed and regulated by the Capital Markets Authority. We have over 30 years of experience helping Kenyans like yourselves invest in shares of companies on the NSE, Nairobi Securities Exchange, and also to invest in treasury bonds, treasury bills, and derivatives. And more recently, international investments. So we are actually very proud to be the #1 stockbroker for local individuals in Kenya in both derivatives and stocks. And one of our mottos is to support you in your trading journey. And this is just one of the ways we do that. We have a lot of support for our clients. So welcome to this webinar. And I'll now hand over to Steve to introduce himself and CDSE before we hand over to our speaker, Ronnie.
Yeah, thanks, Naila. Yeah, so my name is Steve Atema. I work with the Central Depository and Settlement Corporation. And we are happy to partner with AIB on this investor education session. What we do mainly is that we are the main depository for the equities market in Kenya. And if you are buying or selling securities or shares specifically, you will need we are the ones who facilitate that settlement of your shares, as well as the money, depending on which leg of the transaction you're in. We also partners in the product called Dosika, a mobile app that allows you to open a CDS account, an account that you need if you want to own shares and trade instantly. And AIB is also part of one of the partners on Dosika app. So yeah, I'm eager to learn and hear what AIB has in terms of the investment opportunities, and keen to see and interact with you guys in the Q&A session. So thank you.
All right, thank you, Steve. And I think I can now hand over to our speaker for the day, Ronnie. Ronnie, please take the mic. Over to you.
Thank you so much, Naila and Steve, for the warm welcome and the introduction. So my colleague Naila has started the introduction as to who AIB is and our scope of coverage, our value proposition, and I'll just dive right into the presentation. The theme of today's presentation is focused investing, and specifically building wealth using core stocks. The aim of the presentation is to guide you, the everyday investor, on how you can use the stock market to create long-term shareholder value. And my role here is to guide you through the thought process and the factors you need to consider as you dive into the investment journey. So perhaps it deserves a reminder or mentioning some of the benefits of investing in the stock market. Yeah. So why should you consider investing in the stock market? We think, firstly, the stock market is a tool whereby you can realize above average returns. And you earn these returns in two methods. The first method, most notably or prominently, is what we call capital gains or capital appreciation. This is whereby you buy a share at 10 shillings, sell at 20 shillings. That difference per share is what we refer to as capital gains. Secondly, we happen to be in a very vibrant market. Some of our top blue chip stocks are very easy to buy and sell. They're trading every day in the Nairobi Securities Exchange. So that's another benefit. Thirdly, you are entitled to bonus shares. We've seen like this year, some companies have announced bonus issues. Prominently, we have Kenya Re, which announced a 1-for-1 bonus issue, meaning a doubling of your current shareholding. And now it allows more scope for price discovery again. The other channel I was referring to on how you earn through stocks is what we call dividends. The first one was capital gains, and the second is dividends. Some companies announce interim dividends, and then at the end of the financial year, they announce a final dividend. Some may even declare a special dividend. For instance, if they are successful in liquidating a subsidiary, they can decide to distribute that to shareholders in the form of a special dividend. And of course, we know that also shares can be used as a loan collateral. Whenever you're applying for financing, do the valuation of the shares, and then based on that, they can give you a loan or even a fraction of the same based on the value of your shares. And lastly, you get to be involved in decision making of some of these listed companies through AGMs. We know these shares hold voting rights, so you can vote. You have the right to participate at all AGMs of the companies you invested in. Great. So maybe just for context, how has the market performance been in 2024? Just before I dive into the theme of building wealth using core stocks. So I think over the first half of 2024, as you can see on that table on your screen, most indicators are in the green, pointing to indeed the underlying recovery of the Nairobi Securities Exchange. We've seen turnover almost triple when you compare the half year in 2024 versus the half year in the first half of 2023. That is a 225% upside to 46 billion. Market capitalization is also up, signifying investor wealth creation. You can notice just this year alone, the market capitalization has grown 18.9% on average. Yeah, so that is also reflected in the Nairobi All Share Index, which has grown by the same amount. And if we are cognizant also of the fact that the Kenya shilling appreciated quite remarkably in February, since February to date by approximately 17%. Those two factors alone were enough to make Nairobi Securities Exchange the best stock market in the world, which indeed came less than a year after Kenya was ranked, I think, the worst stock market in the world. So that shows you how vibrant or volatile the Nairobi stock exchange is. And what's more remarkable in this is that majority of the increase in turnover is not even driven by foreigners as we usually attribute it to. But this time or this year, we've seen a lot of domestic investor participation that has been driving the bullish sentiment or the recovery in the NSE. But even among the foreigners, with their participation rate at 39% of the total turnover, we've also seen them turning net bullish or net buyers of Kenyan stocks, purchasing a net of close to 3 billion. This is a reversal from the past 10 quarters where there were net sellers. So indeed, even foreign investors are waking up to the opportunities, the rich opportunities present in the NSE. Even if you look at the market price to earnings ratio or multiple, which is a barometer or an indicator of market sentiment, you're seeing it rise from 6.2 to 8.5 and now at 10.2, meaning investors are willing to pay 10 shillings to get 1 shilling of EPS. So this reflects rising expectations of improved corporate performance over coming quarters. And it also reflects the fact that this EPS is associated with higher dividend payouts and even higher capital gains. So we are seeing the indicators that the Nairobi Securities Exchange is surely on a firm recovery path. If you look at the top traded, let's say even the top gainers on a year-to-date basis, you can see there Bamburi leading the charts with a 70.8% gain. KCB coming second with a 55.6% year-to-date. So that's in about 6 months. We have Liberty Kenya in third place with a 51.8% appreciation. East African Breweries at fourth with 29%. Kenya Power at fifth with 28.6% gain. And I think this slide also embodies what I was talking about in the earlier slide regarding the supernormal returns, which asset class can give you, let's say, 50% or even 70% gain in 6 months. So that indeed shows you the potential that underpins the stock market. If you look at the dividend yields, we've seen corporates really try to elevate their dividend yields. If you look at Umeme, their dividend yield was translating to 19.4%. You can see Standard Chartered there also surprised, raising their dividend by 6 shillings to 29 bob. That was a dividend yield of 17.9%. Kengen, the dividend yield was slightly under 15%. So when we combine the capital gains to the dividend yields, we notice you're really getting above average returns or above what risk-free assets would really give you at the present moment. So at this point, I'd like us to see how indeed we can build wealth using core stocks, using the example of Safaricom, for instance. And throughout this case example, I'll be walking you through the thought process and the factors you need to consider when you're opting to invest or choosing to invest in core stock. And as we talk about core stocks, perhaps we need to define what a core stock is. So what is a core stock? A core stock refers to a central investment in a long-term portfolio. Think of it as the vital or the defining investment that you truly rely on, as the word core suggests, to the very crux of your portfolio. It connotes the sense of a solid foundation, and it also connotes a sense of reliability. You can rely on that investment. Yeah. So I want us to delve into the example of Safaricom as I walk you through the process of identifying, first of all, a core stock, then the elements that you need to look at to, deepen the conviction that you are dealing with a core stock. So when you're trying to look for a core stock, what you want to start by is looking at, depending on the industry you've chosen. For instance, Safaricom is a company in the telecommunications space. So you want to start by looking at industry reports, let's say by the Communications Authority of Kenya. We want to see the GSM report to see, first of all, what are the industry developments in the telecommunication space? What are the population trends? What's the adoption of smartphones, 4G smartphones in the industry? Those are some of the industry metrics. What's the population pyramid looking like? And that will help you shape, first of all, a positioning of how the company's future looks like over the next 5 to 10 years. You can then now proceed to situate the company within that industry, looking at the company's market share relative to competitors. Afterwards, then you can now get a copy of the annual report. So for all listed companies, you'll find their latest annual reports on their website, easily accessible, or you can just do a simple Google search. Let's say Safaricom Annual Report 2024. And what an annual report is a detailed document that contains information on management's outlook. We have information on shareholding information. Nowadays we have information on environmental, social, and governance considerations. We have information on the risk management framework and strategies that the company has. And of course, the detailed breakdown of the financial performance for a particular financial year, or usually 2 financial years for comparison. So when we look at, say, for instance, at the financial segment, there are usually 3 popular statements. One we call the income statement, the other we call the balance sheet, and the other we call the statement of cash flows. So this income statement breaks down the sources of revenue for the business and also the breakdown of expenditures by the business. And now the difference, of course, is what gives us the net profit from which shareholders receive dividends. So these are snippets or screenshots of the income statement of Safaricom for financial year 2024. And you can see right at the very top, the breakdown of the various revenue sources from voice revenue, messaging revenue, mobile data, M-Pesa, mobile incoming revenue, other mobile service revenue. And that totals to mobile service revenue. Then we have fixed line and wholesale transit, or fixed service to the home revenue. Together they form the total service revenue. And then Safaricom has the handset revenue and other revenues. Together they bring the total revenue structure. So you can see, for instance, in FY24, Safaricom recorded total incomes amounting to 349 billion Kenya shillings. Yeah. And this is at group level. So it is inclusive of incomes from both all geographical areas of operation. We know Safaricom now launched operations in Ethiopia about 1.5 years ago. So these are aggregate figures. So the annual report goes even deeper. It breaks down the revenues by segment, by geographical region, and you're able to see the trends in each market and analyze them specifically. You can now delve deeper into the forces shaping a particular line item. For instance, you notice voice revenue has dipped a little from 81 billion to 80 billion. So you may be curious, why is voice revenue declining? Yeah. Could it be because of decreased usage, or the price or the rates that Safaricom charges per minute are high now, or high to dissuade or discourage excessive consumption of the voice service? And how is management responding to that trend? Are they lowering rates in response, or are they keeping rates at the current levels? What are the alternatives that are competing with voice revenue? Could it be now these over-the-top technologies like WhatsApp calls, and even video calls, that are competing with the legacy voice revenue as a service? Yeah. And if that's not enough, now are they mitigating or compensating channels which are growing at a much faster pace to compensate for the decline in revenue in the voice? So that frame of thought is what will guide you in establishing the trend, the overall trend for the company you're analyzing. For instance, in this case, Safaricom. If you look at messaging revenue, similarly, grew modestly. Usage has remained fairly constant, but now you realize last year Safaricom lowered the rates on messaging to keep usage at constant levels, and the overall outcome was that messaging revenue increased. Mobile data is where we saw an increase, a double-digit rise at 18% year-on-year to 67.4 billion. And that reflected the increased revenue per user in the sense that users were spending more to purchase mobile data. And this is evidenced by the fact that the number of 4G smartphones have surpassed the legacy feature phones as of Q3 last year. Yeah, so we can see the population dynamics are working in the favor of Safaricom. If you move on to M-Pesa revenue, you can see M-Pesa revenues rose by 19% from 117 billion to 140 billion. And I think that was where we saw the largest growth. That was about 23 billion increase. And there are various factors contributing to this. Increased usage. We saw, like last year alone, M-Pesa conducted worth over 40 trillion worth of transactions. M-Pesa is now becoming a systemic, I think it already is a systemic financial service in Kenya at the moment. With that magnitude of transactions, it's hard to see any competitor that's likely to wage another front or a transaction volume of that threshold. We can see emerging revenue lines like fixed line and wholesale transit. You've seen the fixed fiber to the home or home internet that Safaricom launched, I think, less than 5 years ago. We've seen some traction on that front. The Safaricom market share has also been rising. So this also promise future areas of expansion for the business. If you look at the other revenue lines, we have handset incomes, depending on now the smartphones that they sell. We have other financial services income like Fuliza and Mshwari, which are credited in the other income section. If we move on to the costs, or I'll move to the cost in a later slide. But I just wanted us to see the layout of an income statement and how you interpret it. Looking first of all at the line items, the contributions to revenue and costs, then you can see the breakdown. So where is this whole 349 billion worth of revenue going? You can see their direct costs amounting to 97 billion. Yeah, and I'll expand on that in a coming slide. So the contribution margin is the percentage of what remains after deducting the direct costs. So here we can see a contribution margin of 70.6%, meaning out of the 349 billion, 70% remain after deducting direct costs. Then we have other costs or other deductions from that. We have the depreciation and amortization of existing assets, like of course the towers and even the buildings that the offices and the software that they use. They need to maintain them. So that in itself is an expense. We have on the second page, net finance costs for the debts that they hold. The interest they pay on the debt is accounted for here. We have joint venture losses. Now those are losses or gains from the associates they invested in. And alongside other operating expenses are also deducted therefrom. So after deducting all operating expenses, we have the profit before income tax. And of course, Safaricom being a responsible corporate citizen, it has to deduct its 42 billion worth of taxes for that financial year. So the net pay to the group was 42.65 billion. However, of course, we have non-controlling interest in the Ethiopia franchise, and the Ethiopia unit was loss-making for that financial year, if you look in detail. So the net income that was attributable to shareholders of Safaricom was 62 billion, 62.991 billion to be precise, which was an increase. Sorry, let me just move back. Which was an increase, a 1.2% increase from last year, 62.268 billion. So that in itself shows you that in as much as Safaricom is at the helm, or rather at the dominant market share level, you can see their profit levels are fairly resilient. Yeah. Growing from a base of 62 billion in itself is not a mean feat. So even maintaining or growing even by 1%, that's well over 700 million in extra profits. Yeah. So that shows you the overall performance of the business. Then we have the statement of financial position, where now you can see the trends in the assets and the liabilities of the business. You can see a very detailed distribution from the property and equipment, the software, any leases they have, subsidiaries, and so on. We can see on the current assets, the cash, the contracts and the receivables that they expect. Of course, like for instance, the Fuliza debt is part of Safaricom's receivables. On the equity side, we can see data on the shareholding, or the total shareholder value, share capital, share premium, the retained earnings over time, the reserves, and the dividends payable to shareholders. Then on the liability side, these are the company's debts. We have long-term borrowings, lease liabilities, payables. These are now debts that Safaricom owes other suppliers. You can see contract liabilities. On the current liability section, you can see current tax, debt to the government, borrowings, debt to other financing institutions, and so on. So that in itself gives you a mapping of how well situated the business is. Looking at the numbers over time gives you a sense of the trend, which line items are deteriorating or improving faster than others. And this helps you spot, the trends. Yeah. And now from this, you can make an informed assumption of how faster can, say, revenue expand by from this level. How fast can Safaricom's revenue keep on growing by double digits, for instance? Now, that cannot be answered by looking at the top line. You now need to delve into the specific voice. You need to look at your assumptions on M-Pesa and assumptions on mobile data, message revenue, and so on. So the aggregate of that, and even geographically, we can see Kenya, for instance, you can say it's in the early mature cycle. However, Ethiopia, it's quite at its early stage or early phase, with just over 4 million active customers in a population of over 100 million consumers. That shows you the latent potential of the new market Safaricom is exploring. Of course, Safaricom doesn't exist in isolation. There is a competitor, Ethiotel, which of course is competing for the share of profits. So now looking at other qualitative factors like the strategic overview, the pricing strategy, the quality of the offerings that Safaricom has, the cross-selling capabilities. Now we have Safaricom got M-Pesa license to operate in Ethiopia. So that in itself can reinforce usage of Safaricom's products, just like they did in Kenya. So if they're able to replicate the model, regardless of the competition they're facing, then that can only mean an upside from where we sit right now. Presently, yes, the Ethiopia unit is loss-making, and this reflects the fact that, they are currently at the investment phase. They are setting up the towers. In a population of over 100 million consumers, who, unlike Kenyans, where Kenyans tend to concentrate in urban and peri-urban areas, in Ethiopia, the population is well dispersed. So scaling the infrastructure to the last mile can only mean significant capital expenditure to set up the infrastructure. But once that is in place, and of course with concerted marketing efforts, customer acquisition efforts, then that can support the case for a rise in revenue. Allow me to move on to, I think I've touched on the need to understand the contribution to the total line items. I touched on it a little, but can see here, for instance, financial services contributed 42.2% to Safaricom's overall revenue. And this is being driven by accelerated growth in business payments, Lipa na M-Pesa, Pochi la Biashara, tills, and the tills have really been embraced by businesses. So that has really accelerated the growth. Actually, the growth has expanded by more than 20 billion in less than 4 years, financial services. If you look at now the connectivity segment, which is the voice, SMS, and mobile data, you can see that has remained fairly resilient at 53%, shrunk a little, but it reflects the fact that, yes, we have competition from over-the-top technologies. However, now you need to look at what is the strategic response of Safaricom. Are they raising average rates, or are they lowering? You notice last year the rates were fairly constant, if not lower. So that in itself kept overall revenue fairly constant, if I may put it that way, for voice and SMS. They are largely in their mature phase. So at this point, it's only playing with pricing that can sustain the top line. The next frontier has to be M-Pesa or maybe the financial services segment. And of course, there's the emerging fixed data service. It's growing fairly quickly. But yes, we should expect that to, of course, blend in the overall revenue pool. On the costs, I think this is where I wanted to spend time a little to show you of the 349 billion, where is it going? They're spending on paying M-Pesa and airtime commissions, statutory license fees, their handset costs, customer acquisition and retention expenses. We have repairs and maintenance costs, leases for the buildings and the sites. They have inventory storage costs, employee benefits expenses. I mean, for Safaricom, we know they have over 6,600 employees as of 2024. So, I mean, that can explain, of course, the quantum you're looking at, 30 billion for employees. Auditors' fees, basically administrative expenses to keep the enterprise running, both in Kenya and Ethiopia. So you can see direct costs amounting to 97 billion plus the administrative expenses amounting to 83 billion. So that explains why the top line reduces from 349 billion all the way down to 62.99 billion. Okay, so on this slide, remember the numbers, the absolutes have their part to play, but to make more meaning from the financial information, it's good to also have an understanding of some key ratios. Yeah, like the net profit margin, which simply refers to the proportion of the sales or the revenues that actually translates to profit. So this essentially means 18% of Safaricom's revenues trickled down to net earnings after tax. We have ratios such as return on equity, which essentially means or gives the proportion of returns that shareholders are getting per shilling invested. Yeah. So if you invested 100 shillings in Safaricom, you are essentially earning 27 shillings in return on your investment. Yeah. We can look at the dividend yield, which is what the company paid out to shareholders as a percentage of the share price in the market. So you can see if you bought the Safaricom share prior to the news announcements, then you realize that 8.6% dividend yield. We have metrics such as price to earnings, which gives you the metric of what is the expectation of future earnings overall. If it is rising, then it reflects the expectation that Safaricom will perform better. If it is declining, then it reflects an expectation of decline. We then have the price to book ratio, which gives it's a sentiment of the attractiveness of the stock. Are investors willing to pay? If investors are willing to pay 3 times the book value of the company, then that in itself also adds or reinforces the expectation of a better or solid future performance. So usually, especially for the price to earnings and price to book, companies that are trading above industry or above 1 multiples also indicators of core stocks. They can trade at more than their book value, so they're attractive. We have return on assets, which is of course a measure of efficiency, and the payout ratio, which shows you how much the company pays out of the total earnings per share as dividends. Yeah, so this means that out of the 1.55 shillings per share in EPS, Safaricom paid out a dividend of 1.2, so that translates to 76.4% payout. So at this point, I'd like to do some illustration. I want to illustrate the process of building wealth using core stocks. Using a simple example, still of Safaricom, I want us to see the progression of wealth creation and give you different scenarios of literally how to build wealth using core stocks. So it can be Safaricom, it can be another. So I was just using Safaricom as an example. So I'll start with the example of an investor who invests in 100 shares of Safaricom every month. So I'll take the example of over the past 1 year. If you are buying Safaricom shares at the start of every month, from July last year all the way to June, how much would you have realized? So at July 2023, Safaricom was at 17.75. It evolved to 17.35, to 15, to 14. It went even down to 12. But all through, you are keeping on investing in this core stock. Later, it rose to 14, to 13, 75, to 13.50. All through the process, you're consistent in investing in 100 shares every month. So that's about 1,300. Okay, the amounts vary depending, of course, on the price. But on average, it's around 1,350. Then in April, it went to 1,755. In May, it dipped to 16. Then in June, it went, June 2024, end of last month, was trading at 18 shillings. So what's the evolution here? What's happening to your wealth? So overall, you've spent 18,352 over the past year. So in July, you invested 1,700, 1,735, 1,510. All of this add to 18,352. But now, what is the portfolio market value at the end of June 2024 using the price of 18? That is gotten by looking at the total number of shares you have, which are 1,200 shares, multiplied by the latest price of 18. That gives us 21,600. So there you've realized capital gains, 3,248. And then throughout your investment period, the 1 year you've been holding the shares, you've received dividends. So there was an interim dividend of 62 cents a share and the final dividend of 55 cents a share, which of course, when added to your capital gains, gives you a total portfolio return of 3,800. So when we take 3,800 out of the total amount we invested, 18,000, that gives us a return of 20.7%. So you can see the benefits of consistency. And what's interesting is that when you're dealing with a core stock and you notice that the price has decreased, say from here in October, it moved from 1465 to 1230 in November. If in November you decided, let me double down my investment in this core stock, instead of buying 100, that month I bought 200. What you do is that you are averaging down your weighted average purchase price. And the effect of this is that your overall return is magnified. So your overall return increases from 20.7% to 22.6% at the end of the period. So that reflects the fact that reinvestment is the secret. It's the alchemy of wealth creation. Perhaps I can do another example of another investor who invests in, say, 1,000 shares every month. Fill that to the right. So for an investor who purchases 1,000 shares of Safaricom each month, using the same, of course, the starting prices, the investments, of course, they increase to 17,000 every month. Okay, in July, it was 17,750, went to 17,350. In September, you spent 15,100. October, you spent 14,650. And you're consistent month on month, regardless of the share price movements. Remember, we are dealing with a core stock. And with core stocks, we believe that their present share trading prices will approach their fundamental value as we approach the future. As Safaricom continues executing its strategy across both markets, that will reflect in the share price over the medium term to long term horizon. So as long as you're consistent throughout the process, you will create something that is greater than the sum of individual parts. And even if you take advantage of the moments when Safaricom or the share price of a core stock is decreasing, to double down or to accumulate even more, what happens is that you magnify your total return. So, for instance, before I do that scenario, you can see that in the first scenario where you're buying 1,000 shares every month, you've spent 183,520. And at the end of it, your portfolio value is worth 216,000 Kenya shillings. So there you have your capital gains of 32,000 and your dividend income. Of course, in August, you got your interim dividend, and in March, you got your final dividend of 4,900. So in total, they add to 5,570. When we add that to the capital gains, you have your total return of 38,050, translating to 20.7% return. The same is also true for an investor who invests in, say, 10,000 shares every month. So in the first month, you invested 177,500. The next month, you invested 173,500, and so on and so on. So at the end of 1 year, you've invested a total of 1.8 million. At the end of the investment period, your investment value is worth 2,160,000. So those are capital gains amounting to 324,000 and a dividend income of 55,700. So that adds up to 380,500. So the portfolio return is calculated by taking the total portfolio return, the sum of capital gains and dividend income, divided by the total purchase value, the total amount you spent purchasing the shares over the past 1 year. So I hope that gives you a mapping of how to build wealth using core stocks. And as I've said earlier, reinvestment is the alchemy of wealth creation, consistency. And for core stocks, taking advantage of the dips to even double down can only but magnify your overall return over the long haul. That's the secret Warren Buffett, the principle Warren Buffett operated by, and you can see it paid off for his core investments like in Apple and so on. Buying the dips, as they always say. If we compare the return of, say, that example, Safaricom shares against other alternatives, Treasury bill currently at 16%, money market fund around an average 15.5%, SACCO dividends 14.5%, fixed deposits 14% from my survey. You can see equity investments really do have the potential to give you supernormal or above average returns. Yeah. So I think at that point, I'd like to bring a halt to my presentation and pass the mic back to Stephen Atema. Thank you so much. I hope added value to your to the meeting. Thank you.
Yeah, thanks so much, Ronnie. And I just want you, before even you leave that screen, because sometimes you can never fully appreciate the potential of creating wealth unless you see the numbers. Sometimes when you were told 18%, 16%, it's an abstract value, and when you now actually see the numbers play out, it is quite marvelous. And what you notice is that your return is fixed, but the absolute number changes dependent on the value invested. So if you're playing in the league of guys who can invest over 150,000, then definitely your absolute return will be quite significant. And I think maybe you can also just show, assuming that this investor actually, had an active, because I'm assuming if you're investing over 100,000 in the market on a monthly basis, I would hope that you also have a good relationship with your stockbroker. So part of what even a stockbroker does is that they ensure that when they know that the stock price has gone down, like in November, I believe this is November, and in March, if you can just show if this guy even didn't double, they just added 5,000 in the month of November, in the month of February, in the month of March. I think March was when they were about to announce their results. So if you had a good relationship with your stockbroker, I would assume that they had told you to double your, not double even, maybe say, okay, 123, I've already put 123. So they say, ensure that you maintain it at 177. So if you add another 5,000, it's 15,000 in November. And then your broker tells you again, Safaricom is closing its books in March, and we anticipate, based on the half-year earnings, that again they are likely to increase. So you double your February and March, and you wait now for the May announcement. You could see that you could if you had put the same investment, because remember when you're investing in the stock market, my belief, or any investor's belief, should be it's an active process. You are not investing just you're not investing like how you would invest in a bond, where you're looking for this would be 1.9 million. When you're looking for 1.9 million, the beauty with the capital markets is if it allows you that if you are able to earn an income consistently that would allow you to build your portfolio steadily, you can benefit the same way a guy who had 1.9 million and invested in a 5-year bond earns the same return. So I hope that also the investors or the audience gets to appreciate the flexibility of the stock market. And should you decide that after Safaricom pays their dividends in March, and after Safaricom announce their dividend and pay it, I think they have not yet paid, but after they announce their dividends, of course the price will likely shoot. And if you decide even to exit at after 6 months, you have already made your 430,000, which is a 22% return. I really hope that the potential income one can make in the stock market is alive to everyone. And remember, if you had 1.9 million at the beginning of the year, it would have even been a bigger opportunity for you to earn, because you would put your 1.9 million and then you continue putting your 10,000 at the end of the period, as opposed to somebody who has 1.9 million who is putting it in the what's the word, in the bond market. Because ultimately the person who is investing in the bond market needs to have this amount, at least if you're doing directly and you're trying to avoid fees. You're putting 1.9 million in a 5-year bond. If you try to sell your bond after 6 months, chances are that you'll be selling it at a loss. So I hope and I believe that our audience is appreciative of the actual return that you can generate in the stock market, and especially when everybody is saying that people are losing money in the stock market. Because I remember, I think the president made a statement the other day when he was having his dialogue with the nation, and I cannot speak for a lot of things that he said, but the thing that he said was that the stock market was the best performing market, and a lot of people bashed him, maybe because of the other things that he had said. But based on what Ronnie has shown us, indeed Kenya was the best performing market, and continues to be, especially because we are still at a regime where the dollar is stabilizing, and also companies are about to do their payments, and of course after we finish the cycle, then we have another cycle of quarter 3, quarter 4, and half-year earnings. So of course it's not all rosy in the stock market, but when it's good, it's actually really good. And I would just hope that each one of you who is in this session would take action and actually engage your stockbroker. AIB is one of the stockbrokers. You can ask them whether it's a good time to buy. Even seeing what has happened in Safaricom, is it a good time to buy now at 18 or maybe it's trading at 17? The whole goal is, in my view, is as an investor, you ought to try not to be to predict the future. Your goal should be, I want to buy these securities, and I want to buy these securities for a fixed period of time. You're saying I have an objective of having 130,000 shares by the end of 12 months. So whatever the price is, I'll buy it. And just to cement what Ronnie had talked about in terms of what a core stock is, in my view, a core stock is a stock that you are that is, I would call it a conviction buy, where you have said, I am in my 20s, I am in my 30s, even I'm in my 40s or 50s, and I have only 10 years of serious significant earnings. Now I want, by the time 10 years from now, maybe I own 1 million Safaricom shares, or I own 1 million KCB shares. So it's a conviction trade where you're saying, I believe that this company in the next 10 years will not only grow in terms of paying out dividends, but it will also significantly increase in the value for me. So I can then buy this security or buy this share without worry of where the price is going. And indeed, after a long time, then you can say, okay, maybe I'm retiring. You can use this as your pension, or you can even hand it over to your kids or your future generations. So I would just like us to start from that, even as we enter the Q&A session, to fully appreciate, because the whole point of these sessions is not just to sell you Safaricom as a counter, but to tell you that there's significant potential in the stock market, and you don't have to have your 1.9 or your 190,000 or your 19,000 at the beginning of the year. From whatever income you can participate in the stock market. And it does not mean you stop investing in your SACCO or saving with your SACCO, or buying bonds if you can, but it is prudent to diversify your investment and invest in companies that are actually providing good counters. You become what we call an allocator of capital, because when you're an allocator of capital, you don't need to be a specialist in tech to become a technology company. You can give people who are good at running companies like that, and you generate your wealth, so that you don't have to the 10,000, 20,000 you're pushing to your side hustle that never gives you returns. Could be you could give Safaricom or Safaricom management, in this case, your 10,000 every month, and they'd likely generate better returns than you currently are. But yeah, let's dive into the Q&A session. I was seeing you, Ronnie, play with the numbers. Do you want to comment further before I ask some of the questions I saw in the comments?
Oh, okay. Yeah, I was just trying out different scenarios just to show us in this event when the market price dips below your weighted average purchase price, you should take advantage and accumulate.
Okay.
Yeah.
Okay. Yeah, I think that point is home. Hopefully, it is home.
Intensify the investment when the market price dips below your weighted average purchase price. Because that gives you a good base to start from and maximize your overall return. Yeah.
Yes.
Yeah.
And like we said, a conviction trade or a conviction buy or a conviction stock or a core stock is a stock that you believe, come what may, whether it's COVID, whether it's Gen Z protests, this company will still be able to generate revenue or deliver value to their shareholders. And if you're a shareholder, then you should be rooting for your company. And I don't want to sound like a nationalist, but I see comments about Starlink is coming. Sometimes I get curious why we root for our own companies to fail. If I were an investor in Safaricom, I would be thinking, how can I help Safaricom become like Starlink? Starlink's Elon Musk's Starlink. But I would like you to also answer that question. But there's one question that I wanted us to start with, even as we handle the questions. And please just keep them coming, and we shall we shall surely address them. I want us to spend a few minutes on the Q&A because sometimes that's where somebody needs to be convinced about the purchase they're making. So there was a question about, you're telling us all these things. How do I start buying shares? Because we are dealing with both experienced investors and novices. So maybe you can just give a very short explanation on how to buy shares, on how to start buying shares, and then I delve into now the more deeper topics.
All right. So the process of investing in stocks is simpler than ever. All you need is to first of all get a good broker. And what a good broker is in the present context, you want a broker that's able to offer you a digital solution, a digital approach to investing in the stock market. No one wants to visit offices and fill forms anymore. So at AIB-AXYS, we have an award-winning app, AIB DigiTrader, which you can download from both Play Store and App Store. You can easily key in your credentials, your name, your national ID number. You can upload an image or a photograph or even a PDF of your ID, or even a passport as identification. You can fill in your address details, your bank account details, where now, let's say your dividends your dividends will be credited to. Then after approval, which takes, I think, less than 24 hours, you will have access to the stock market. Of course, you'll have to fill the CDS form, which of course that takes nowadays, I think for manage expectations, 3 days. Then immediately, I mean, you have access to an app where you can access, buy, quote your limit order. It's very easy to use. It's very easy to navigate. And if at all, of course, you're having any challenge, of course, maybe the next question is, so where do I invest? Yeah, which stocks do I buy? So at AIB-AXYS, we offer you researched recommendations, giving you tactical views, the tactical opportunities you can take advantage of at that point in time, because the markets are ever shifting. So you want a broker who can give you an edge into the market. And as such, yeah, AIB-AXYS, we pride ourselves in filling that gap. Don't just buy the stock because it's a top gainer that day. Yeah, you need to dig beneath the surface. You can consider even making a call or even an email, or we have our research recommendations available on our website that you can always access and get a good recommendation to buy. Then once you get the core stock from our recommendations, it's now about now staying consistent, as we've discussed.
Okay, thanks, Ronnie. So if you need more information, I've shared with you the Dosika link on the platform. You can register and start your investment trading. I think on Dosika you should be able to get your account if you choose a broker like AIB on that platform. You should be able to get your account up and running within a day, and then you can trade after the account has been opened the next day. Now, there are very good questions, and I want us to just try to be brief, Ronnie, but try to also be insightful to the audience. Now, a lady, Irene is asking, if I have 200K and I want to build dividend stocks, should I buy one counter or should I distribute the 200K in 3 or 4 stocks? Now, my view would be, if I have 200K, I would. That's why we're talking about core stocks. I would be putting it on. I would be doubling down. That's my personal view, but I would like to hear on it. For me personally, I would be doubling down on a counter until I reach a minimum target of shares. Maybe if I want to grow the shares to 500,000, so that when they give me 1 shilling per share, I have 500,000 every year on my account. But it could also be that, of course, because of the risks and whatnot in the stock market, you might have different opinions, Ronnie. So please just try to guide Irene on whether she should, because you're the analyst here, whether she should buy one stock or she can distribute it in, maximum 4 stocks.
Okay, thank you, Steve, and thank you, Irene, for the question. I think Dividends is just half of the story. You also want opportunities to realize decent capital gains. So core stocks are very heavy on capital gains or growth. Dividend stocks, a good dividend stock may not necessarily be a good core stock in the sense that it may not offer you significant capital gains to make up. You want to maximize your overall alpha. So all in all, I think we have several options apart from the one I was just discussing. We have other core stocks, which I believe can give you decent headroom for capital gains. Like for instance, looking at KCB as well, it's one attractive counter that I think offers a significant scope for growth. Looking at Stanbic Bank Kenya and also Standard Chartered. Standard Chartered is now a good dividend stock, but yes. So all in all, I think it's now about playing with the weights you allocate to each stock. But all in all, just to simplify it, you want to have a portfolio that gives you both the best of both worlds. You want to grasp as much capital gains as you can, but also getting the best dividends. So you can focus on the one that has the best dividend yield and focus on the best, the one that has the best scope for capital gains. So that net, you're winning on both sides, on the value and also the income spectrum.
Okay, thanks, Ronnie. So basically, Irene, what Ronnie is saying, you want to have a dividend counter as well as a growth counter. And my view or my opinion would be then talk to your stockbroker. If it's AIB, then they will guide you on these 200K, which ones are the best dividend counters, which ones are the best growth stocks. There was a question about whether examples of other examples of core stocks. You've mentioned KCB, you've mentioned Safaricom. So I think we have answered those questions, asking about if Safaricom if KCB is a core stock, it would be a core stock. Remember, core stock is a stock that you are the one who is convicted by that stock. It could be a core stock for you, but not a core stock for me or Ronnie, because maybe I have a bias towards banking stocks. So I'm looking at one counter or two counters in the banking sector. So I don't think it would be prudent to say this is a core stock for this is a prescription of a core stock for everyone. But in my view, and Ronnie, please just give a brief answer to this, whether these core stocks, if KCB, there's a comment on equity. Basically, guys are asking, can you give them maybe 2 or 3 more core stocks after Safaricom? Maybe let's say 4, so that you cover also different industries.
All right, so I'll try to be broad-based. Maybe I can even present sample of our monthly stock recommendations, which we publish on our website. So you can visit AIB-AXYS website. So if you go through our coverage universe, you can get to see our tactical views over the next 1 year horizon. We have a mapping of the current price of the counter, its target price over the next year or less, and the upside potential in percentage terms. We have the strengths that we discuss for each stock together with the risks we are seeing, and the recommendation is a balance of the strengths and the risks. So you can see our views on Equity Group, KCB, Diamond Trust Bank, Stanbic, NCBA, Standard Chartered, EABL, Safaricom. So you have a good buffet to select from.
Okay. Okay, thanks.
as we go on.
So
Yeah.
for those guys who want to know about other stocks that they can invest in as their core, remember, if you invest in 5 stocks, are they really a core stock? But you can see that if you are not interested in Safaricom or you already hold Safaricom, then you can look at AIB-AXYS stock recommendations, and maybe you can put the link, Naila or Ronnie, for the audience to just click and go to the page. Another question, as we try to cover everyone's. There's a question here by Inc. What are your thoughts on investing in expensive quote unquote stocks as core stocks? I guess when he says expensive, he means stocks maybe that trading above 50 shillings per share.
Right. I think it's inconsequential as to the price level in itself should not be the reason why you invest. You shouldn't really consider investing in a counter just because it's trading at, let's say, 20 cents a share. Neither should you consider investing in a company because its share price is trading at, say, 500 shillings a share. You need to look at more fundamental drivers of the company as opposed to the absolute share price. So a core stock will be defined by characteristics such as especially on the performance side, that would communicate more and should convince you more in merely looking at the share price and making the convenient action.
Okay, thanks. So there's also another question. I think this was in regard to your presentation about the different price points of the example you are giving on Safaricom. There's a I don't know if you can speak to this or you would have to do a presentation. I'm trying to try to have questions answered as brief as possible. But let's see if you can handle this. How did you get to the weighted average price? Maybe just explain what weighted average price is and how you got to it in your presentation. I assume that when the presentation is shared to the audiences, they will see what we're talking about.
Okay, yeah. So the weighted average price simply refers to the average price of your total portfolio. Remember, each month, the prices of stocks are fluctuating. Some months we've seen the share price is at 17.50, another month is at 12.30. Yet, if you're buying similar amounts of shares, or even different amounts of shares, if you want to know the average price per share of your holdings, there is some computational calculation. We look at the total value of your portfolio based on the different trades. Then we divide that by the total number of shares. That gives you your weighted average price.
Okay, and I guess more can be explained when you actually talk to AIB through their social media channels or on their their listed contacts. How does one change from one stockbroker to another? This one, if your broker is not AIB and you want to move to AIB, you can actually move to AIB without changing your stockbroker per se, because you can have more than one stockbroker. But if you want to move with your portfolio, then what would happen is you would visit your current stockbroker, fill an account transfer, we call it a non-account transfer form, have them confirm that it's you who is doing the transaction, take the form to the other stockbroker that you want to move to. They'll process that transfer. So you start with your stockbroker, have them fill, and it's because it's your shares, they cannot not fill, and if they refuse, you can always reach out to CDSC. Please explain the concept of buy and hold, how it works. Do you buy once and wait to sell later, or you keep doing the purchase consistently? Ronnie, what do you mean when you say buy and hold?
All right. So there are different investment strategies. There's the buy and hold, and then there's the rebalancing approach. So buy and hold essentially is whereby you're purchasing a stock this month, then you essentially cease further investment action from that point. You're not purchasing, you're not adding on to, neither are you reducing your holdings. Yeah. That strategy, in my view, doesn't pay off as much as a consistent. It's almost like tending to a tree. You have to consistently trim it for you to get the beauty out of it. Yeah. So a consistent approach to investing, as I've described or illustrated, in my view, or from my computations, rewards investors much better than the classic buy and hold, buy and forget about it approach.
Okay, thanks. Guys want us to also talk about the possible losses in the stock market. I guess they're talking about the risks. So what are the potential risks when investing in the stock market, Ronnie?
Okay. In as much as we are talking about above average returns, yeah, it's worth noting that investing overall also comes with risks, especially if you don't have a structured approach to it, or you don't have any informational uh, edge. Yeah. If you are coming into the stock market as a novice and you've not gotten any edge, let's say by getting a research report on the best stocks to invest in at that moment, then there is a significant risk that you may lose out by selection or sampling error. You've decided to or test the market using the first stock you see on the trading board. Apparently, it may not necessarily be the best stock to invest in at the time, so you end up losing on your investment. Yeah. So to avoid this, we really advocate that you need a broker. You need to nurture the relationship with a broker. Disturb the analyst with calls and emails and messages to give you an edge, yeah, over which stock or which core stocks you can take on at that time, especially in the stock market.
Thanks, Ronnie. A question on if you can open an account for your child. Yes, you can. Talk to your stockbroker. They'll help you fill a minor account opening form. Must I monitor the market price changes, or can I just invest for the long term? I guess Andrew wants to know if he needs to, be on top of things every time, to look at the price changes, or can he just invest without worry about the price of the security?
For core stocks, I think you only need but look at the market movements periodically. This is only for you to make decisions on when you need to double down on your investments. You don't really, of course, not need to look at it every minute by minute. Even on a monthly approach, as I've just described or just illustrated using the Excel spreadsheet, can suffice. So that at least you're keeping abreast with the developments. But in any case, if you need to look at them daily, you still can.
Yeah, but I would also caution against, when you unless you're a trader and a daily trader, looking at your stock portfolio on a daily is just you're asking for, what's the word? Hypertension, because stocks will rise and fall. Like somebody has said, they bought Safaricom last week and it's 2 weeks ago and it's down 9%. So if you're actively also looking, it can also make you a bit jittery, and you might sell when it's not time to sell. But even if you decide to, be an active participant in the stock market, again, if you are not a trader or an analyst yourself, I would always encourage you to talk to your stockbroker, so that in times when you are not certain and you want to know, maybe that could have been the time you should have doubled down when people are selling, especially like he said on core stocks. So I guess we also answered your question, Mito, that I bought Safaricom and it's down 9% the last 2 weeks. Yes, if anything, if you are buying, if it's down 9%, you can talk to your stockbroker whether it's time to double down or to add. In my view, 2 weeks is too short a horizon in the stock market to be too worried, especially if it is a counter like Safaricom. But I would still say, or I would still encourage any person who is new to the stock market to always, and I'll repeat, always engage your stockbroker before you make an investment decision. And remember, it's a long-term play, so you're buying on a regular basis. We've already answered how you can get started on the stock market. You can also check on the comment section for the link on Dosika. KCB, you said, is a good anchor stock, and Ronnie will, to the people who are here, we shall also share the stock recommendation, that recommendations list that you have presented to us. Does AIB charge for buying and trading shares through them? I guess there's that normal fee, trading fee that you're charged when you're trading in the stock market. It's capped at 2.1% by the Capital Markets Authority. So I can assure you that the fee that you're charged is 2.1%, and it's not even going to AIB-AXYS alone. Even CDSE gets a share of that, NSC, Capital Markets Authority, and I think it's the Investor Compensation Fund, if I'm not sure, or the Settlement Guarantee Fund. But yeah, there is a fee, and it's 2.1% maximum. In fact, if you're trading at above 100,000, you should be able to negotiate a fee, a lower fee. So we also encourage you to be a big spender in the stock market. Question: to answer that guy who has asked about equity, and another one who has asked about KCB.
Yes.
What could you just maybe share? Because in your earlier presentation, you showed that KCB, I think, had grew by in terms of the price gain was over 50%. Could you maybe speak to that so that people don't also flock to KCB, imagining that those returns will be sustained? Could you just speak to why KCB reported such an exponential growth in its stock price?
Yes. So starting with KCB, breaking down the reason behind the 55% appreciation year to date. You will recall last year with KCB, for the financial year ended 2023, KCB did not declare dividends. And the justification was, one, the business was coming under pressure, especially because with the non-performing loans emerging from the National Bank of Kenya subsidiary, and deterioration, of course, in the manufacturing sector portfolio. We noticed even capital buffers were very thin, close to the ground. So investors were pricing in the deteriorated performance or the deteriorated health of the business. To add to that, KCB did not pay dividends at a time when competitors were raising their dividend yields. So that in itself also deepened the bearish pricing. It dipped, I think, to as low as 16 shillings a share. But then fortunes reversed when KCB in Q1 announced their decision to liquidate or sell off the National Bank of Kenya subsidiary, and the fact that they recorded a very strong double-digit rise in earnings per share by Q1 alone. I think it was well over 50%, 53% growth in profit after tax. And the capital buffers were then replenished. So all in all, now investors will then see that that was a good management call, and investors now priced back the optimistic expectation. But I still am of the view that there's still more scope for KCB to recover or to trail back to. With a book value of 72 shillings a share, we think KCB is very, very much undervalued. And we think there's deeper scope for KCB to take advantage of. With Bamburi, we know last year they announced the successful sale of the Hima Cement subsidiary in Uganda. They were divesting out of the Uganda business. The share of the proceeds out of the 120 million US dollars, I think the share was about 84 million US dollars. So investors, of course, were expectant of special dividend later in the year. But more recently, the needle mover was the announcement that Amazon Holdings intended to acquire 100% of Bamburi shares at 65 shillings a share. So that in itself also, that was some significant material information, material pricing action that we saw in the subsequent days, not even weeks, a matter of days. The counter had appreciated. I think it went up 28% in a single day, the day of the announcement of the news. So that was a one-off as such. But all in all, we were still bullish on Bamburi. Nevertheless, we were expectant of a very juicy special dividend, even without the acquisition news. But we do know that as things stand, all shareholders of Bamburi are entitled to the special dividend that will be forthcoming. So we should wait for that over coming weeks.
Okay, cool. What edge does AIB have over DigiTrader? In my honest view, if you're already an investor in Dosika, you don't need to have an AIB app. But if you're already an investor in AIB DigiTrader, you can, use the DigiTrader app. If your phone can allow you to have both, I think you can just have both and experience. Sometimes I might have biases, Ronnie might have biases, but you as the customer know what works for you. Several customers like the DigiTrader, other customers like Dosika. So in my view, each app will serve you differently, but you are the one to choose because different customers have different needs. So I would say if you can have both, try them out for a week. In any case, if you're buying on Dosika or you're buying on AIB, as long as on the DigiTrader, as long as you made the purchase or you made the sell, the money will not go anywhere. It will still be in your brokerage account. Same with the shares will be in your CDS account. So having the app in different, you can actually trade on Dosika and AIB DigiTrader at the same, not per se at the same time, but you can trade on both. So you don't need to worry that if you choose Dosika, you will not have access to AIB DigiTrader. The portfolios will be synchronized because CDSC is the one that has that data. What are your views on long-term as opposed to regular trading? I think, Ron, you can answer this briefly. What are your thoughts on long-term as opposed to regular trading? I guess he means, active participants in the stock market.
I think both are equally good strategies, good approaches, but now there are different factors to consider under each approach. Of course, with day-to-day trading, you have to be very hands-on, very up to tabs with the market developments, but it tends to be riskier than the long-term approach or the
Okay.
when you when you stretch your investment horizon a little, that is less risky, and you get to realize you get to navigate the journey to price discovery on a more stable footing than day
If you're
trading.
doing daily. Okay, makes sense. But of course, again, you can reach out to Ronnie on through their email to just get better insights. Remember, you're trying to cover everyone's concern. Thanks, Ronnie and Steve, for the session. Should I look at balancing the industry when choosing core stocks? Personally, I would say if if you're playing with something less than 500,000, in my view, I would go on a conviction trade, buy one stock until I'm done. But again, Ronnie is the analyst and he might argue differently. So Ronnie, please let's answer, what's her name, Maureen, on whether she should put all in one industry, like example banks, or should she spread her risks?
Personally, I'm always pro diversification, but selective diversification. You need to, yes, you in as much as you want exposures to different sectors, telecommunication, banking, manufacturing, to even out the risk across industries. You don't want to be spread too thin, and spread too thin so far as to take up as less than core stocks. So you can diversify, but selectively, picking the very core stocks per sector, rather than, of course, intensifying across all the sectors in different weights or evenly spread weights. I think that will give you a much better footing when different industries have different business cycles. So when, let's say, banking sector is up, or energy sector is up, maybe the manufacturing sector is experiencing a headwind. So overall, you're evened out, yeah, on a risk perspective. Yeah.
Okay. there's still more questions on how much brokers charge. Like I said, the fee is fixed. 2.1% is the maximum. If your broker is charging more than that, you should report them to CMA. And I highly doubt any regulated broker is charging more than that. Guys, we are really trying to go through your questions, but unfortunately, we will not be able to answer them. So I would just urge you to engage AIB-AXYS on their social media platforms, or even CDSC on our social media platforms at CDSC Kenya. But I'll just handle two more, and then we can call it a close. For a beginner investor who has very low risk appetite, what is the number of shares I should be holding of any stock? 500, 1,000, Ronnie? Is there a minimum number of shares or maximum I should be holding as a novice?
I think the minimum is 100 shares of any stock.
Yes.
Yeah, but we can even have odd lots as well. So I don't think there's really a bare minimum per se, given that we have odd lot trading. But as a rule of the thumb, we usually advocate for 100 shares as the minimum number of shares you can start with.
Maximum?
I mean, is there a maximum? Now your wallet will define the maximum.
Okay, so yeah.
Yeah.
There was a question about where are dividends paid to, investors bank account or investors brokerage account. The bank account that you provide when you're opening a CDS account is what you will be paid. If you want to update this again, talk to your stockbroker to update your bank account that receives dividends. Yeah, I think that is as much as we could handle. Does the IB allow kids account? We've already talked about that. You can open a junior account. Transferring shares, deceased cases, please reach out to us on helpdesk@cdskenya.com. I've sent that email there, or again on our social media handle. I wish we could handle all these questions, but we have to be also cognizant of your time as well as ours. And yeah, that's it from me facilitating this Q&A session. I have thoroughly enjoyed the questions. I have thoroughly enjoyed the presentation, and look forward to interacting with you guys and actually hearing stories of success from you guys having participated in the stock market. Again, if you're not if you don't fully understand how to invest in the stock market, I would implore you to actually talk to your stockbroker for investment advice on which stocks to buy, when to buy them, and how many shares you can buy in, depending on the amount of investment amount you have. But if it were me, I would encourage you to pick a stock, buy it on a regular basis, of course in consultation with your stockbroker, but build a portfolio where you consistently buy it. If you are generating returns after if you have income after quarter, you can buy it quarterly. If you can do it monthly, do the same, but just build a habit of investing in the stock market, and surely you shall also be receiving those millions in terms of dividends, as well as in terms of the value of your portfolio in a few years. But guys, if you have any more questions, again, talk to us on our social media handles at CDSC Kenya. AIB-AXYS will also be sharing this presentation to all of you who have attended, as well as the stock recommendations list. And for those who will want also the recording, it will also, chances are it will be on both CDSC and AIB-AXYS's YouTube pages. Any closing words, Ronnie, before we go? And again, much thanks for your presentation and your insights.
Thank you so much, Steve, for organizing this, and many thanks, of course, to our listeners. I mean, staying all through the evening, engage. And I hope and I trust that we can now take action upon what we've learned, and build our wealth together and grow through the investment journey. Thank you so much, Steve, and looking forward to the next one.
Yeah, thanks, Ronnie, and thank you, Naila. For those guys who still want the Dosika link, I have shared it on the chat. I'll give you a minute to click it and download it before you go, and then I can close the session. But that's it from us. Have a good evening or good morning or good afternoon, and stay safe. Thank you. Bye.